As of August 10, 2026, the market session has closed, and MARA Holdings Inc. stock closed at $10.09 per share, marking a decline of approximately 5.25% from its prior session baseline. When people look at Tesla stock, Apple stock, or Nvidia stock, they see companies defined by consumer demand, product cycles, and end-user hardware adoption. But when investors talk about MARA Holdings Inc., the widespread consensus is far simpler and much more reactive. People view this equity purely as a levered proxy play on Bitcoin. The prevailing market belief assumes that if digital assets rise, MARA stock goes up, and if digital assets drop, MARA stock falls in tandem. That expectation is straightforward, easily packaged, and dominates message boards across the Robinhood app and various investing sites. However, reality paints a far more complex picture. Relying strictly on that simple narrative overlooks a major structural shift happening beneath the surface. MARA Holdings Inc. is no longer just a passive crypto miner waiting for token price swings to dictate its valuation. The company is actively executing an aggressive pivot into owned power generation, high-performance computing, and enterprise artificial intelligence infrastructure. This strategic transition fundamentally changes how value is captured, yet Wall Street continues to price the asset almost exclusively off short-term crypto sentiment. To understand why this disconnect creates a massive rift between market expectation and underlying reality, you have to look directly at recent order flow, institutional positioning, and trading activity. When you examine the daily volume spikes on platforms like Fidelity Investments, Interactive Brokers Trading, and SoFi Invest, MARA stock consistently stands out as one of the most heavily traded instruments in the digital asset space. But recent trading sessions reveal intense volatility. Following their latest earnings report, where the company logged a net loss driven primarily by fair value adjustments on digital assets, heavy selling pressure pushed the share price downward toward the $10 level. Retail traders using Robinhood fractional shares or self-investing options on individual brokerage accounts saw the headline loss and immediately hit the sell button. What the broader market overlooked in that knee-jerk reaction was the sheer scale of operational repositioning taking place behind those numbers. Institutional investors operating on Interactive Brokers platform and Fidelity brokerage channels were not merely reacting to liquidations, they were monitoring capital expenditure reallocation. MARA has been strategically utilizing its balance sheet, allocating capital toward acquiring massive energy assets, including a major power plant acquisition in Ohio and site developments in Texas, to control the single most expensive input in digital compute: power. When energy costs spike, traditional miners without dedicated power generation see their profit margins collapse immediately. By vertically integrating energy assets and expanding power capacity through natural gas and grid balancing initiatives, MARA is insulating its operational baseline from power grid fluctuations. Furthermore, their majority acquisition stake in European enterprise AI infrastructure provider Exion demonstrates that management is building a dual revenue engine capable of servicing high-performance computing workloads alongside standard block validation. Comment below how many shares of MARA Holdings you currently hold in your portfolio and whether you view them as a long-term infrastructure play or a short-term trade. To grasp how MARA reached this inflection point, it is helpful to look briefly at its foundational background and core business model. Originally incorporated in 2010 as Marathon Patent Group, the firm operated for years in patent licensing before executing a complete pivot toward blockchain technology and digital asset infrastructure. eventually changing its name to Marathon Digital Holdings and more recently rebranding to MARA Holdings, Inc., the core operation historically centered on purchasing large fleets of specialized ASIC hardware, setting up data centers, and validating transactions on the Bitcoin network. In the standard mining model, revenues are dictated by three variables: global network hash rate, block reward halving schedules, and the market price of the underlying asset. Under this legacy setup, if asset prices stagnated while network difficulty increased, operational margins compressed rapidly. To survive and scale, MARA evolved beyond simple hosting agreements, moving toward full site ownership, global data center deployment across North America, Europe, and the Middle East, and active balance sheet management. This historical perspective clarifies why the market narrative remains stuck in the past. Investors utilizing Schwab Intelligent Portfolios, SoFi Active Investing, or General Intelligent Portfolio strategies often screen MARA as a high-beta technology stock. They compare its charts against broader market benchmarks or index funds offered through Fidelity ETFs and Fidelity mutual funds. From a superficial standpoint, MARA looks like a simple speculation vehicle. But when you examine their recent shift towards securing over 500 megawatts of dedicated power and entering enterprise AI compute, the reality reveals an industrial power and data infrastructure operator masquerading as a pure-play crypto miner. Looking toward the future, the primary catalyst for MARA Holdings centers on its execution speed regarding power monetization and AI compute diversification. If management successfully transitions a significant portion of its power footprint into high-margin AI inference and high-performance computing contracts, the stock's valuation metrics will likely disconnect from pure token pricing. Under that scenario, Wall Street would be forced to re-rate MARA using multiples closer to data center and energy infrastructure providers rather than pure digital asset miners. Conversely, the risks remain real and immediate. Capital-intensive acquisitions require substantial liquidity, and balance sheet write-downs during market downturns can continue to create sharp earnings volatility. If digital asset prices experience sustained downward pressure, or if power plant integration faces regulatory or operational delays, short-term cash flows could remain constrained. Investors conducting online investing through SoFi robo-advisor tools, Interactive Brokers fee comparisons, or Robinhood cash management options must weigh these operational risks carefully against the long-term infrastructure upside. The divergence between expectation and reality is where opportunity and risk collide. While the retail crowd focuses on daily tick-by-tick fluctuations on their Fidelity mobile app or Robinhood stock trading interface, institutional capital is focused on power assets, megawatt capacity, and computational pivot potential. MARA Holdings stands at a critical crossroads where its identity as a digital infrastructure firm will either validate its massive capital outlays or leave it exposed to broader market swings. In summary, the popular consensus views MARA stock strictly as a volatile crypto proxy. The deeper operational reality shows a firm aggressively acquiring power plants, expanding into European AI compute, and building vertically integrated energy infrastructure to protect its margins and diversify revenue streams. Understanding this gap between perception and operational fact is essential for anyone evaluating investment help, online investment opportunities, or self-investing strategies in today's changing markets.